check, check, signal, enter the trade, boom. Again, check, check, signal, enter, and boom. This simple process can transform your trading decisions. In this video, I'll show you how to use this indicator step by step, so stay with me until the end. Let's get started. First, open your platform, click Indicators, and search for Jurik MA Trend Breakouts by Big Beluga. Once added, it appears directly on your price chart. The indicator has two main parts. The first is the Jurik Moving Average, shown as a color-changing line that turns green or blue depending on market direction. It's a smooth, low-lag moving average that reacts quickly to price movements while filtering out market noise. When the price stays above the line and it's green, the market is trending up. When it moves below the line and turns blue, the trend is down. If price moves far from the line, it shows strong momentum. If it pulls closer, the momentum is weakening, often a sign of a pullback or possible reversal. That's the first part. The second is the breakout signals. These occur inside ongoing trends and highlight where price breaks through key levels. To understand them, remember that every market has structure. It's either trending or ranging. In an uptrend, price forms higher highs and higher lows. In a downtrend, it forms lower highs and lower lows. If this pattern disappears, the market is likely consolidating. During a trend, a special concept appears, the break of structure, BOS. Here's how it works. In an uptrend, price usually pulls back after forming a short-term swing high. That high becomes temporary resistance. If a candle then closes above that high, it's a breakout suggesting the uptrend may continue. In a downtrend, the opposite happens. A swing low forms before a pullback. When a candle closes below that low, we get a breakout pointing to further decline. The indicator automatically finds these moments. It detects the structure and marks those breakout zones. The Jurik Moving Average confirms whether the signal aligns with the current trend. Example: the moving average is green, showing an uptrend. Price pulls back to the line. The indicator marks the recent swing high, and when a candle closes above it, an arrow appears. That's our buy signal. In practice, you'd enter a long trade when that candle closes. Set your stop loss below the pullback or near the green line. For your take profit, use about a 1.5 to 1 risk-to-reward ratio. The same pattern can repeat: pullback, breakout, and continuation. Follow the same entry and exit method each time. Then, when price starts hovering around the line and finally closes below it, the line turns blue, signaling a downtrend. Now you switch to taking sell signals. Here's a downtrend example. The line is blue, so we look for downside opportunities. Price pulls back upward, creating a short-term swing low. Once that level breaks and a candle closes below it, the indicator marks the signal. You could open a short trade, set the stop loss above the pullback or line, and set a 1.5 risk-to-reward target. Sometimes the next trade forms soon after. Another pullback, another break below structure. But remember, not every breakout leads to profit. Some will reverse. Even well-structured signals can fail, and that's part of trading. What matters most is risk control. No method removes false signals completely, but you can limit their damage. The best way to do that is good risk management. A simple and effective method is the 1% rule. Risk only 1% of your total capital on any single trade. So, if your account is $1,000, your maximum loss per trade should be about $10. That discipline protects your account even through a losing streak. Let's quickly recap the process. The Jurik Moving Average defines the market direction: green for uptrend, blue for downtrend. Breakout arrows highlight when price breaks important structure points. Trade only in the direction of the current trend color. Use a consistent risk-to-reward setup, around 1.5 to 1. Always apply risk management to preserve capital. When used together, these rules create a clear, methodical trading approach. The system combines trend confirmation with structure-based breakout analysis, producing clean and reliable visual signals. Here's one last scenario. The line stays blue, indicating a downtrend. Price rises slightly, forms a swing low, then drops below it again. When that candle closes beneath the low, that's another potential short setup. You'd enter there, place a stop above the line, and target your usual 1.5 risk-to-reward ratio. Whether you win or lose that trade is less important than following the plan precisely. Over time, consistency and discipline produce stability. Trading isn't about predicting every move. It's about playing probabilities and managing risk logically. Even if your system wins only around 60% of the time, a solid risk-to-reward ratio can keep you profitable. That's why you follow the same structure every time. Check, confirm, signal, trade. Simple, repeatable, effective. And that's it for this tutorial. If you're still learning, go back and review the section about market structure. It's the foundation of this strategy. Try it on demo charts, observe patterns, and refine your confidence before trading live. Thanks for watching. Stay patient, stay disciplined, and trade smart. See you in the next one. Good luck with your trading.